Hello, Mr. Jens.
Hello, Theo.
How are you doing?
Doing good. So little hot over here in Germany. So we don't have electricity, but we have the sun. So
Oh, it's good. If you have sun in Germany, you're super lucky, mate.
oh yes. So the only problem we're having here is now we have sun, but the people are still not very nice. So
Hey, it's okay. Give me some time to absorb some of the UV. I think it's gonna help. What's going on with the non-farm today?
I'm surprised. I'm really surprised. So numbers came in weaker than expected, and it's a surprise because after yesterday with the ADP, I think we could have expected a significant better print. And
Oh
it's not
yeah.
just it's not just today, but it's also a downward revision for the last months. It's
Mm.
not just last month, but months. I think, well, I'm not really sure whether this will make a big impact or not. Especially when I'm looking at the S&P or Nasdaq. I'm not really
Yeah,
sure.
it's not much of deviation from the action from the forecast. Actually, you know what? I had on a spreadsheet before, and I was monitoring the ADP and the non-farm, the deviation from the forecast to the outcome, and always, I don't remember a single time that the ADP comes positive and the non-farm payrolls confirm always or possibly if the ADP shows positive US dollar, the non-farm payroll it comes in totally the opposite from the ADP. I don't
Okay,
know
that's
why.
interesting.
Yeah,
That's interesting. And how far back did you check this?
about for 5 years.
Okay, that's good. So it's
It was
like
when I used to keep records of the events
okay.
when I was intraday trader and I was trading this stuff. So uh, I need to
That's
know what sort of expectations. Yeah. So
yeah, that's
yeah,
very
and,
very
and
interesting.
I noticed that difference between the ADP. It's supposed to help the forecast, but for a reason it was very often showing one number and then the non-farm payrolls. And I said it on the webinars every time we have this every week when we have the non-farm payrolls. I say usually we see the opposite. If the ADP shows bullishness, the non-farm payrolls it just makes the other way around.
I
So
think, well, when looking at EURUSD, I think the price action was kind of, let's say, telling yesterday. I
yeah.
think so. We saw this flush lower. I think it was confirmed with the ISM, if I'm not mistaken. So ISM services came in. I wouldn't say very strong, but still better than expected, and especially
Yeah, you're right.
prices. And then we saw the flush lower, but there was no follow through. But we already drifted back. And I think, given the bigger picture, I would say,
Yeah.
and holding above, I think it was 08, right? 08, 0850, something like that.
Yep.
And that was something in the morning. There was one guy asking me which direction I think EURUSD is headed, and I was like, well, I'm more likely to see a spike up to 110 or a spike. Let's see, probably it's a little more than that. And I think this is exactly what we get right now, right? So it's around 109, 10. Let me just check here.
Yeah.
109.
109.06.
Yeah.
Yeah. It's 100 pips. And that's it. Easy. I'm sure it's going to be an interesting webinar today. Yeah.
I hope so.
I'm sure everyone will enjoy it. There are lots of people and well done, guys. And we all thank you. Jens, myself, admirals, we all thank you for your support and being here. It means you find so much value out of that. And yeah, nice.
Shall I share my screen?
Absolutely. Absolutely.
Okay, so
Okay. Wish you best luck.
yeah, thanks, and have a nice weekend. Enjoy
You
yourself.
too. You too.
See you
Yes.
next week.
Bye bye.
See you. Bye-bye. So yeah, hello, and I welcome you to today's trading spotlight. Let's trade the NFPs event. Very, very interesting print, in fact. We want to go through this in depth, what it means, especially what it means probably from a rate perspective, Fed perspective, I think that's probably very interesting, at least what I think we can make out of this. And I have bad news in this regard, that I don't think that it will impact the overall price action at all, even though the initial reaction and right now seeing the drop back is kind of, I would say, telling for the short side. And why do I say that? Well, we saw a weaker than expected print, which wasn't expected, especially after yesterday, as I already said at the beginning, given the ADP print. And we saw a spike higher. I just watched the NASDAQ, respectively, the Qs in this case, the spike on the upside. And then we were sold off again. So we are right now at where the pop higher started. And to be honest, I think we are overall, especially when looking at equity indices, in a lose-lose spot right now. So it doesn't really matter if numbers come in better or weaker than expected. That was before they were now released. Now we know they are weaker than expected. But I think we are in the lose-lose spot because especially given the overall extension on the upside and yesterday's price action, I think lots right now depends on if we can hold yesterday's lows. And when it comes to the S&P 500, when it comes to the NASDAQ especially, if we can, let's wait. I mean, we have to wait and see whether we drop these levels, and in around 20 minutes we know more. Right now it's the pre-market, it's still the pre-market. So on the spot market, when Wall Street comes in and we finally see volume picking up, then we probably have a better idea of what to make out of this. But given what we are currently seeing in the market, I think it's a tell to the short side when it comes to equity indices. And I think still we shouldn't overinterpret the numbers, but just take them and see it kind of a, let's say, event which is probably helping us forming a bias, or most of market participants, and then taking it from there. But I don't think that it really plays an important role when it comes to today's price action. But way too much, right here already, way too much. First of all, we have to start with a risk disclaimer. And first of all, as you might have already guessed, let me just check it here. Okay, right. So we're looking here at leverage products, and they involve risks which are not suitable for all investors. So before you start trading, please make sure that you understand all risks involved, that you then go over to admiralmarkets.com, download a demo, check the product yourself in a simulated environment, see if the risk profile of CFD FX products suits your personal risk profile. And then if you understand all risks and if you test it yourself with a demo, you can certainly also move forward and open a live account. For further details, please check the website, admiralmarkets.com. Please read the risk disclaimer carefully, and also please contact Admirals if you have further questions on CFD FX products in general. If I today here make any kind of it's not a recommendation, it's not an advice, but it's no financial advice. It's purely educational content, purely informational content I provide to you. And please don't misunderstand this as financial advice or something. But I want to make sure that if we formulate a trading setup, and if you plan to trade the setup then and use my thoughts and my thinking process here for your trading, that you please make sure that you understand that you're taking full responsibility for every trade you're taking. And again, this is no financial advice in any form. I don't think we need to further introduce Admirals more. I think Theo did most likely a very, very important and very good job already here. Fully fully regulated broker for over 20 years in the industry, CISAC, FCA, ASIC regulated, also a regulation with Jordan. What this means for your trading, please feel free to check out admiralmarkets.com, the website respectively. Reach out to Admirals directly for further explanation. One world, one broker, but today's topic will be employment numbers, and this is exactly what we want to look at now. And first of all, we want to start with a simple question so that we are all on the same page. So, by the way, can I Okay, this is interesting. Whatever this is. So having some funny stuff here in my Zoom right now. So first of all, that we're on the same page, we have to start with some theory and then take it from there. So why are employment numbers of interest? So usually there's kind of a, let's say, chain we're following here. So if the confidence in the economy, respectively, especially in politics, is good, and politicians, there's trust, there is a positive outlook, then this should usually, and we are focusing here on the manufacturing side, we are not focusing on the service side, and respectively non-manufacturing side, but just to have something we can better imagine, let's say. Probably that's a good way to put it. So then you see an increase in orders in factories. So people who are looking into a prosperous future, they will most likely invest their money. They will also go out on themselves, and then they say, well, you know what, I'm founding a company and I have to hire people. I will go to a bank, ask for a loan so that I have the money to fund my business adventure in this regard. And if the overall confidence is also positive, that means that people are usually spending their money, respectively, they have more money, they have a good job, they are looking into a nice future, they're willing to build something, let's say a house, to have a family. And so that usually this consumption means that they are buying more goods, which means the orders in factories usually increase. You have an increase in industrial production. Companies will want to meet the higher demand here through more investments, respectively. They have to produce more. More investments means they have to hire more people. Hiring more people means if you want to hire the best, if you have strong demand, and people are demanding your product, then you have to make sure there's competition. Then you have to make sure that you're offering the best product. To have the best product, you need the best workers. To have the best workers, you need to pay the best salary. So that means the workers will be compensated accordingly, or probably, let's say, above average, which means naturally that there will be an increase in average hourly wages. And the natural result will be that there's more people having a higher income, which means we have an increase in consumption, higher propensity to consume, and thus the higher propensity to consume, the more people demand, and the more they are buying, the more economic growth there is overall. More economic growth means that companies can raise prices for their goods, naturally, because the demand is there, and they have to they have to hike prices, which means inflation starts to pick up. Heating up inflation in this case means, okay, a central bank has to make sure that the overall economy is not overheating, hiking rates, and thus reversing the cycle, because the higher the rates rise, the more expensive it will be to take out further loans, which means there is fewer demand for loans, for money. There's less money flowing around, let's say, and then we see a rollover, dive into recession, a reversion of this cycle until there is another positive outlook for the future, and the cycle starts over again. And this is, in fact, the perfect reason why employment numbers are a very good indication of how can I say, how well an economy is doing. I think it's self-explaining to some extent, even though the current environment is very, very different, because the rise in inflation wasn't due to strong demand and economic growth, but the rise in inflation was mainly due to central banks flooding the market, respectively, governments around the globe handing out stimulus checks to people, and giving them something sweet, let's say, to stay at home and be locked out of the economy, respectively locking down the economy due to the COVID pandemic. And if you interrupt the supply chains and there's fewer goods being produced, but you're flooding the markets with liquidity, well, there's lots of money chasing fewer goods, which means inflation is picking up. While the economy overall is already weakening, and this is exactly what we got to see. There was a short-term rise, massive run higher in equity markets, especially. And we saw some very, very strong growth outlooks. But the problem was that it wasn't sustainable. And over the course of the year 2021, especially when inflation started to pick up and you were capable of seeing that, we knew that rather sooner or later there will be a need to increase rates, which the Fed did then very aggressively over the course of the year 2022. And from there, well, we are now in an environment where the Fed shows herself. We are looking at the US here in this context, but we can do the same for Europe, for example. We're seeing very, very high interest rates to combat inflation. While the overall situation seems still solid. It seems as if the economy is not really slowing down, but in fact is still growing. The interesting thing is, this is the reason why in the current environment, you need to carefully watch where the jobs are especially created. That was one reason yesterday, especially, why the numbers around, and therefore let's head over to here. First of all, the non-farm payrolls, but probably we start one day earlier. Oh, I'm sorry, that's the wrong one. So this is the ISM. I want to have the ADP numbers here. So where do we have it? There. So you can see yesterday there was a print 497,000 against 228 expected. Which was significantly above expectations. But what was interesting was to see where were the jobs created. And therefore, you can see here, the service sector added 373,000 jobs, led by leisure and hospitality, trade, transportation, utilities, and then education and health. And there were job losses in information and financial activities, and then some in professional businesses. Why is it noteworthy? Well, because you have to see where are the jobs created, because you get an idea. You have an idea on what quality, what kind of quality are these jobs. What quality or how well do these jobs pay? That's probably a better way to put it. And especially leisure, hospitality, for example. I usually would say, well, this is more low wage, right? It's not really high paying jobs like the financial industry, for example, being a trader, investment banker on Wall Street, or working as a programmer, or somewhere in the information industry, software companies, whatever that might cover here in this regard. So these are usually low wage jobs, which means it seems likelier, let's say, that the jobs which are demanded here are from people who probably can't make ends meet and have to take 2-3 jobs to provide for their families, which is, it's at least in my opinion, not a sign of a very strong economy. That's why here it makes sense to read between the lines, I would say. So I was already very skeptical yesterday when these numbers came out, because you say, well, 497,000, this is a big beat. But then I see, okay, what's the market making out of this? And I'm heading over here to the so-called Fed Watch tool. And this is, by the way, the next slide. Let me just probably go back here to the presentation. I snapshotted this. That was before the non-farm payrolls were released. And now you can see the numbers didn't change that much. Just for explanation purposes. But by the way, let me just copy paste this, and here, Fed Watch tool. I want to share this with you, so it's for free. You can check this out yourself and play around with it. By the way, okay. So, what you can see is that, or here in this regard, just to explain what this is. So this is a chart which is created from the CME, Chicago Mercantile Exchange. You probably have heard about this. There's futures options being traded here. And these futures options, which are traded there, especially when looking at options, you've probably heard about the Greeks. And there's components like the delta, the gamma, beta, theta, rho, and these give you a possibility. They're crucial. They're essential to price an option, and they give you an idea, or they help you to see, or based on these components, you can calculate how market participants are positioned in expectation of what the Fed will do next. The interesting thing about the Fed is that around 3.5 weeks ago, so Wednesday, 3 weeks ago, the Fed came out and said with their dot plot, you probably recall this, we made this a topic here within our Trading Spotlight webinars. The Fed said, well, we are hiking rates by another 25 basis points twice till the end of the year. Right now, so they paused 3 weeks ago, 525 basis points. 2 more brings us up to 550 to 575. So now this is what the Fed is telling us with the dot plot. The interesting thing now is if you look at the CME here and what options are pricing our futures, well, what you can see is the market is expecting the Fed at the end of the year, given what we are seeing in options being priced at this stock exchange, we see that here with over 60% probability, market participants expecting the Fed to be at 525 to 550. So this is 25 basis points less than what the Fed just communicated. So the market is not trusting what the Fed is saying. And the interesting thing now was coming back to the employment numbers. This didn't change much. So yesterday, usually what you would say is, okay, the market is not trusting what the Fed is saying. To some extent underpricing. The Fed is saying, well, 25 basis points twice in the upcoming or on the upcoming forecasts here till the end of the year. Then employment numbers come in very strong. So at least at first glance come out very strong. ADP numbers in this case, good indication for the non-farm payrolls. And now what you would expect is market participants here saying, trading options, well, okay, then the Fed is most likely to really hike rates 2 times 25 basis points each. And thus you expect these columns to shift to the right. They don't. Why don't they? Well, most likely because market participants are looking at the numbers from yesterday the same way I do and saying, well, look at where these jobs were created. So this is not a sign of a strong economy, and the Fed can't hike rates more aggressive or significantly higher, probably 25 basis points, but that's it. And so given this bias, we are now in an environment where we have the Fed communicating further rate hikes, or at least, let's say, keeping them at an elevated level for a prolonged time span, while the overall economy it's not weak, but it's also not very strong, let's say. And this is a very difficult environment to be in, especially when looking here at the charts and looking, for example, at the NASDAQ in this case here, and looking at this accelerated run higher. So we have a very strong uptrend since around October, November 2022 here. So this is, let me just probably make this a dotted line. So, okay, so the dotted line is the one we are looking at in a few seconds. It's an, let's say, acceleration of the uptrend. And we have a strong uptrend. And this blue line here is my, let's say, mean reversion line. So if I expect the market to correct, the NASDAQ in this case, coming in, then I'd say I'd expect it to retest this trend line. So even if we are now coming under pressure, I'm not saying that we are crashing or that we are entering a bear market or something like that. That would be ridiculous. It's just a mean reversion trade. And what I think is kind of surprising is how aggressive the market accelerated here from around the beginning of May on the upside. And it wasn't just the uptrend, the bull market, which we entered, or we exited, let's say, the bear market from 2022. But the next leg higher, which I interpreted as kind of a more or expectation of a more dovish stance from the Fed in the upcoming months, due to, let's say, the tensions in the banking sector we've seen there over the course of the month of March, for example. So probably market participants here are saying, well, the Fed can hike any further. In fact, the Fed needs to cut rates, and that's the reason why we're anticipating this. So we should also, and all the time, remember the market is a discounting mechanism. That means we are looking into the future, and we're anticipating a more dovish stance from the U.S. central bank, which is positive for, in this case, tech stocks, which should result in an acceleration on the upside. And that's exactly what we got to see. And then we get this communication 3 weeks ago, but we're not pulling in, or we at least not initially pulling in. And then we are rolling over to some extent and then pushing back again to the highs. And now probably we're about to form kind of, let's say, kind of a double top here. But the question was always, well, what happened here? And I think it was kind of a window dressing into the quarterly close, kind of like portfolio managers saying, hey guys, we have to have the best stocks in our portfolio, which we want to sell our portfolio / our fund. We want to sell it to the broader street. And we need to sell them something which just performed extraordinarily well in the first half of the year. And what did perform extraordinarily well? Microsoft, Amazon, Google, Apple, new all-time highs in case of Apple, for example, Meta, for example, Tesla also, NVIDIA, especially due to the artificial intelligence developments. So, and what are these stocks? Well, they're big tech names. They have a high market cap. And if you buy these stocks into your portfolio to have them, and you're buying them into the quarterly close, the last, let's say, 2 weeks of June, well, the market will not significantly drop, even, let's say, if it should, whatever it should do. But usually you see the market holding at an elevated level. But once this demand diminishes, and this is usually the case then when the new quarter starts, well, you have a reason to see a drop on the downside. And that's one of the reasons why I expect kind of a rug pull move, even though I have to say, as of now, we are still very stable when it comes to the NASDAQ compared to the DAX, for example. So the DAX here accelerated massively on the downside and dropped significantly. And it's probably about to form a very significant top, especially now with showing clear signs of holding below 15,700, in my opinion. By the way, there's a funny story I'd like to share with you. I had a short position, in fact, yesterday. So I was short. And I had the short position already from Wednesday, but I forgot, I forgot about the short position. It was like, the reason I took the short was because this thesis I just presented to you is one which is in my mind for some time now. I was then here looking at the price action. That was the DAX on Wednesday. And I saw this drive lower. And I saw also that we have a first target around 15,700. And then I see here after the pop around 9 a.m. German time, Xetra open. That was when the spot market traded or started. We saw a pop, and then we weren't capable of making it back above these highs, and we were holding here below this blue line, which is the EMA 50 on a 5-minute time frame. And I shorted. It wasn't here. I took a short here, I think, and I got stopped, I think, around break even, if I'm not mistaken, or a small loss. I'm not really sure. So we're really, it was nothing. It was like commissions, and that's it. And then I continued to watch the price action, and a very small position, so no big thing. And I saw that we had really trouble here making the back above the EMA, and then we were about to open the Wall Street around here, around this time. And I said, well, let's take, that was around here. I took a small short position, had a stop here above these highs. And then I had something else to do. I was focusing on another working field. I'm making a podcast, by the way, for the German Apparels team. And then I just forgot the position. I went to the gym, and then in the evening, around 10 a.m. German time or p.m. German time, when markets were closed, I just was like, it struck me, and it was like, oh my gosh, I forgot the position. And I just looked and was okay. Nothing happened so far, so we rolled over. And the next morning, when I woke up and I planned to take it out, I saw that the trade was ahead 100 points already. So I entered here around this area, and the next morning when I woke up and checked the market, I saw that we dropped with the Asian markets, and I then said, okay, well, I hold the position. Let's see how it plays out. I trailed my stop here to the highs again of the spot market, which were here around 15,850 or something, 860. And then I kept the position, and I said, well, I hold the position as long as we're holding below the EMA 50 on a 5-minute time frame. This is my line in the sand. It's my identifier when it comes to the overall advantage and where we're standing. And I'm saying, as long as we trade below that, the bias is short, and then I'm holding a short position in this case. And as you can see here, we held this blue line the whole day. The whole day we held this position. And yesterday around here, when there was no further selling pressure in the US markets, and the NASDAQ and also the S&P held, and that was surprising. Let's have a look here at the NASDAQ 5-minute chart. So we came in Europe weak pre-market, then we're dropping further, but there's no real trend happening on the downside. And then we reclaim the opening point, I think it was around here, and we held, and that was a sign, okay, we are not yet there to rug pull or to see some bearishness, and that was the reason I said, well, probably this is something we will get to see in the evening, probably as kind of a preparation into a very weak weekly close then. And when this didn't happen in the US markets, I just said, okay, well, I'm then taking out the position. Well, we haven't yet crossed back above the EMA 50, but I got more lucky than I deserve here with this run yesterday. And I took out the position. And as you can see, so far, it seems to pay out. But that was just a funny anecdote at the end. So please make sure you don't forget any short positions you might have, or long positions in general. Don't forget them. Please don't forget them. Don't make the same mistake, even though I got paid handsomely for that. But that was more luck than I have thought, and I think I deserve. And most likely the market will rather sooner or later come and take it back from me. But just a small anecdote. If it ever happened to you, well, it happened to me too. Coming back now to where do we stand? So overall, again, the DAX is very weak compared to something like the NASDAQ, but I could imagine we have a chance to see a similar move as we've seen yesterday in the DAX also, especially in the NASDAQ. I think the NASDAQ especially because the NASDAQ is very yield sensitive. And what I'm looking right now at here, based on the non-farm payrolls we just got released, by the way, we're talking about the market. Let's just check out here the numbers and what we got to see. So non-farm payrolls came in at 209,000, surprisingly low. Again, usually if ADP prints better than expected, you expect the same for the non-farm payrolls. And this is a very weak print given what we had yesterday. And also here, it's not adding any speculation when it comes to the Fed watch tool and yields in general. So it seems as if the economy is not as strong, or at least when we're looking at the employment numbers, probably that's a better way to put it. It's not as strong as you might think. And that being said, in combination with a more hawkish stance from the Fed, or higher rates for longer than expected, increases the likelihood that we are potentially dropping this accelerated trend line, this dollar trend line here, and at least go for a test of the region around 14,700, probably even lower than that. And my line in the sand now for the NASDAQ, even though as of now, we haven't yet seen any bigger move, but what I could think is the line in the sand. As of now, I'm not interested in being long or being short, but once we drop yesterday's lows and hold below them, and you can see here the dotted line coming in, this is then the clearer sign that overall this accelerated trend is broken, and we are now ready to go on the downside for this flush scenario, probably likely to what the DAX has shown us. On the other hand, if we're not breaking lower, well, okay, then I need to have a look at where we are probably headed from there, probably then we are going for another attempt to break higher, even though right now, again, so let's see, opening range. I think this is, no, it's not the opening range, but we are trading around these lows. So we're 5 minutes into Wall Street trading right now. So this is like we're the price development we're currently facing here. The price action itself, I would say, is not a very strong sign, to be honest. So like, because you see the initial flat spike higher, that's something you would expect if numbers come in weaker than expected, because it makes a more dovish stance of the Fed likely, but we are sold off immediately, and this is usually not a very strong sign, to be honest. By the way, let me just check something here at my screen. Let me just check it here. Okay. I just have to type something in here. So 1 second. Okay. So again, that's a very weak reaction. It's nothing I didn't see coming. So I don't think that the NFPs itself are capable of delivering an impulse, especially given what we just saw with numbers showing some kind of weakness, which is usually positive for equities due to a more dovish approach from the Fed. And now the market is trying to make sense of this and finding a fair price, and thus that's the reason why I would say, well, let's just wait and see. So very choppy action so far. So this is a 5 minute chart. Nothing happened so far, but I think once we drop 15,040, it's very likely that we are going for an attempt here down to the lows from yesterday. And if these levels drop again, then I think we can talk about, or we will soon start to talk about a double top, which we just formed, with the potential acceleration on the downside. First target 40,700 and probably lower than that. So this is how I would attack this non-farm payrolls release for today. Probably also of interest for us. We talked about this with Theo at the beginning. EURUSD. So I think it's not very interesting right now because the price action, or looking at the chart, this is not very, like, I don't like the EURUSD right now with the very low volatile environment we find ourselves in. But still, you have an opinion, let's say. Let's look here at the hourly chart, and let's just look at the price action from yesterday. Probably let's go to a 5 minute chart. This is an hourly chart. Let's go to the 5 minute chart. So that was yesterday, the ADP numbers. So you can see we come from 09, around 09, we flush lower. It's 40 cents, 40 pips. We bounce a little and we see another leg lower due to the ISM service numbers. Better than expected. Hawkish stance from the Fed. Okay. ISM service better than expected, especially pay prices come in lower than the month before, but above the expectation. So hotter inflation. It's not really hot inflation, but it's also making a more, let's say, hawkish stance from the Fed likelier that she will fall through with 2 further rate hikes. And then we are drifting higher and we're making back all the losses. And you can see here, so it's nothing, it's no big move or something. It's nothing significant strong what we get to see here, but we can clearly see there's no follow through on the downside. If we go to the hourly chart, you can see here. So the market is holding this area around 0850, 0840 around. And at least for me, it was kind of telling that the market is not following through on the downside on the numbers. And now we get weaker than expected non-farm payrolls, which is bearish for the US dollar. And I think this is the sign now we are ready to go for the run higher after these flushes yesterday, which didn't let us break lower. I don't want to be long right now, but I wanna I want to focus here on 0930 around. If we break above 0930, I could imagine that this is probably the sign that we are then headed for 110 again. That doesn't necessarily mean that we are overly bullish for the euro in general, but let's say from a chart perspective, that looks promising, more promising for the bulls, especially if you look here at this potential curl up, and we are probably headed then for a test of 110, and then we need to see whether we can break and hold above, and if so, well, then we are potentially headed for 111, 112. We are holding the 200 SMA in this regard, or if we fail again and drop again and see another test of the region around 108, probably a retest of the 200 SMA here on the downside. So that's my view on EURUSD. I think trading wise, especially given this overall picture, I to some extent think that this looks more promising, especially for the potential on the downside, and especially after a day like yesterday with this sharp drop we've seen here in the DAX especially, and knowing that Nasdaq is capable of doing something similar. I think risk reward wise, this is more interesting, in fact. And I'd also like to give gold here a deeper look. So this is gold on a daily chart. Just bring this in here. I'm still not positioned, but I was last week. I had a short position on. I just want to show you why I was short. So that was, I think, it was kind of an interesting price action. That's probably a good way to put it. So I was, let's just see, 3rd of July. That was last week on, no, that was Monday. That was the flush. Where do we have it? Here. So there was an interesting move. That was on the 23rd. I don't know why. I really have no idea what happened here. Most likely, if I look at the timestamp, probably that was kind of a release of a news release, something like that. Whatever it was, it wasn't sustainable. So we spiked higher. We came in, and then on Monday, the 26th, I just saw the price action in the morning and was like, hey, this looks interesting here. So we came in. We were bought higher right from 9 a.m. German time. Oh, 11, 9, I'm not sure. 9. Okay, 9 a.m. Headed to these highs, and then we had trouble. And once we saw the trouble here, I was like, well, you know what? Let's just give it a try, because overall, and risking against these highs from last Friday, because overall, looking here at the hourly chart, it looked some kind of, there was further weakness to be expected. That was following the Fed, and we dropped the Fed lows here. And we we couldn't make it back above them, especially after this Friday flush lower. And I shorted here, and I said, well, the target on the downside, I'm risking only 5-6 USD per ounce here. And I'm looking on the downside for a test of probably a flush below 1,900. And I still had this bearish bias, and was more bearish here. And this completely changed. So the trade obviously worked. Was very nice. I didn't participate here in this flush lower, but I already covered there, because there was I think it was the day before here, there was a spike lower, and then we were bought back, and I was kind of, let's say, irritated, because there was it was only a drift. It was no dynamic move lower, let's say. And this, I mentioned that for one reason, because this bearish bias has completely changed right now. I think we are done on the downside. There was yesterday also very interesting price action when we let's go again to the 5-minute chart here. When we looked at the ADP numbers, so you can see here, this is the timestamp. So that was the ADP release yesterday. We saw this aggressive flush lower, and as you can see here, we are holding above 1,902, 903, bouncing from there, retesting again, and holding and drifting higher. And that's interesting, because we didn't break below this, I think, psychologically relevant level below 1,900. And now, given the numbers we've seen from the non-farm payrolls, we are trading higher, which is no surprise. And this adds to my conviction. We are done on the downside, or at least I'm not seeing further aggressive selling from here. And in fact, now I could imagine that we will at least get to see an attempt here to break this trend line we formed from making this small spike to new all-time highs. Still, it's not enough for me to see a break back above this trend line. But what I want to see is I want to see gold trading above and holding 1,935, 1,940. But if we hold, I think then from there, we are probably headed for another run up to 980 to probably 2,000. And that's that looks promising, let's say. It looks really promising. And now we have conviction, probably even more due to the NFP releases we just saw. But we want to see the close above 1,935, 940 probably, something like that. And then I think then we have further room on the upside, headed for 980, 2,000 probably. So that's it. I hope you enjoyed it. So more trading related. So not such a great focus on the non-farm payrolls. Again, we wanna make sense of this data release here, and I hope you learned something. You see that it already all the time depends a little on the overall context. It's not just the numbers, and they can be better than expected, and that's why the market has to do this and that. But it's always a question of, why do they come in better than expected? Because initially you can see, well, there's no algos fighting, and then you see a spike up or down or whatever. But in our time frame, most of the time we are not as fast as algos, but we have to really work with the numbers and then build a trade hypothesis, or at least that's the way I do it, and then have a longer time frame. May it be for the next hours, let's say, in terms of intraday swing, or probably a swing trade for some days based on that. And as Theo mentioned at the beginning, usually what you should do is mistrust the first move. So most likely you're better off to just wait and see, and let the dust settle, and then taking it from there, interpreting the news, seeing if your interpretation of the news is corresponding with the price action, and then having conviction to pull the trigger and take the trade. Yeah, and that's it. So let me finish here with the presentation and the last slide. If you have any further questions, please feel free to check out the website, admiralmarkets.com. Below the video, comment. Ask your questions. Also reach out to Admirals directly, to their service desk. They will forward the questions over to me so I can answer them. And that's it. Have a nice weekend. Enjoy yourself. Hopefully you learned something. Happy trading all the time. Watch your stops. Talk to you again next week on Friday. I really look forward to it. See you. Bye-bye.